Hey everyone, welcome back to Corporate Decoder, the place where we unravel corporate secrets. Today we're diving into WATSCO's proxy statement. It's like their annual report card, but instead of grades, we get to see who's on the board, how much the executives make, and what big decisions are coming up. Think of it as a sneak peek behind the curtain, but be warned, some of what we find might make you question if the show's worth the price of admission. Let's jump right in. This proxy statement is essentially WATSCO's way of asking its shareholders to vote on important company matters at the annual meeting. It outlines everything you need to know before casting your vote, from electing directors to approving executive pay. It's like a cheat sheet for being an informed owner of the company. The big item up for a vote is the election of directors. The document tells us who they're nominating for the board. Holders of common stock get to vote for Gary Tapella, and holders of Class B common stock vote for J. Michael Custer and Valerie Chamel. Think of it as different teams voting for their players. Now, what if you're too busy to actually vote? If you submit your proxy without marking your preferences, don't worry, they'll vote your shares in line with the board's recommendations. So if you agree with the board, you don't have to do anything. If you want your voice to be heard, you need to take action. What about attendance? To get anything done at the meeting, they need a quorum, which is a majority of the outstanding shares of both common and Class B stock, represented either in person or by proxy. So every vote counts, even if you're voting from your couch. Let's get to the juicy details. Executive compensation. This section explains how WATSCO pays its top executives. It's important because it tells us what the company values and how they're incentivizing their leaders. It is worth noting that WATSCO really focuses on what it calls generational ownership, which seems to mean they want to keep the company ownership within a few families. That's very unusual for a public company. WATSCO does things differently in this department. Instead of giving executives bonuses that can be cashed out, they use restricted stock that doesn't vest or become fully owned by the executive until retirement age or later. This is very different to most companies and means that the executives have to stay with the company for the long haul for their compensation to be valuable. This is supposed to keep the executives focused on long-term company performance and not just short-term gains, and it seems to have worked pretty well. So who are these lucky executives? The filing lists: Albert Nahmad, the CEO, and Aaron Nahmad, Barry Logan, and Ana Menendez, who are also named executive officers, a title you might also see referred to as NEO. The company saw record sales that were up from the prior year, which is what every investor likes to hear. However, operating income was down, though cash flow was up significantly by 38%. Earnings per share also dropped a little. What this tells us that WATSCO is generating more cash, but they are doing it less efficiently. Interestingly, directors must own at least $100,000 in WATSCO stock, and NEOs must own stock worth at least 5 times their base salary. That's a lot of skin in the game, so their interests are aligned with shareholders. All of our directors and NEOs satisfy these minimum requirements. Here is a financial performance table. Now let's look at the company's total shareholder return. A table outlines WATSCO's annual total shareholder returns compared to the S&P 500, which shows how the company's stock performed versus the market. Over the last 5 years, WATSCO has achieved about 25%. That is excellent performance. Now, if you look back over 30 years, they are returning nearly 20% compounded. What this really means is that investors have done really well compared to how the market is doing in general. This is the single thing to consider when investing in a company. Can they consistently outperform the averages doing in general? This is the single thing to consider when investing in a company. Can they consistently outperform the averages? The chairman and CEO's potential compensation is determined by the company's increase in earnings per share and the company's stock price. That is to say, the executive can't just do what he wants. He's only rewarded if those increase and punished otherwise. Delving deeper into how they determine these rewards, we get to a financial table that shows us a summary of restricted stock awards held by the executives. On average, the leaders are in for the long haul as shown, with the holding period ranging from 14 to 24 years, meaning they see the value of their stock grants when they retire. This section gives a list of what performance is considered important. The interesting thing is there is no actual target defined for the execs to hit. In addition to just stock and salary, they also can get an extra incentive for doing some operational actions at the business. It does have very specific requirements for what the execs need to hit, including hitting a targeted level of inventory turns, and they need to have organic sales growth. It is worth noting these rewards aren't minor. The chairman in 2024 was rewarded $5.4 million. The president was rewarded $9.3 million. It is significant to state that what they are awarded is in stock and not cash. Turning to corporate governance, we see that The board is responsible for nominating directors and has a nominating governance committee. They look for candidates with a commitment to shareholders, entrepreneurial backgrounds, and financial expertise, among other things. It is very noteworthy that the company takes into account diversity when it comes to hiring directors. Before we wrap up, let's recap what the board is recommending you vote for. They want you to vote for the election of each director, for the approval of the advisory resolution regarding the compensation of our named executive officers, and for the ratification of Deloitte as the company's independent registered public accounting firm. This document highlights their focus on safety, employees, and risk, which tells us what management actually cares about. Every organization has to deal with some level of risk, and that is no different for WATSCO. They've implemented an enterprise risk assessment process to identify, assess, and manage risks. The document tells us cybersecurity is a particular focus, and their audit committee gets updated about it at least once a year. Let's talk about who owns WATSCO. A table in the document shows the biggest shareholders. BlackRock Inc., FMR LLC, and the Vanguard Group are the largest owners of common stock, with around 10% each, but Albert Namad owns most of the Class B common stock with a whopping 76.2% stake. This is a clear demonstration of concentrated voting power. Digging through all this info, what do we think about WATSCO? WATSCO seems well managed with a clear focus on incentivizing long-term performance and a solid history of returns. The family control and unique compensation structure, while unusual, appear to be effective, but I would say there are some potential risks. The company's reliance on a few key suppliers could be a vulnerability, and it needs to be careful about managing risks, especially cyber threats as the world changes. Their focus on generational ownership might also cause some investors to turn away. On the whole, the numbers are pretty solid though. As long as they can manage these risks, WATSCO's long-term performance should continue to track well. So that's all for today's Corporate Decoder episode. If you enjoyed this deep dive into WATSCO's proxy statement, don't forget to like, comment, and subscribe for more corporate dissections.